today is guiding investment principles. Why buy and hold? And hold on, let me just adjust some of my settings. Okay, there. Why buy and hold? Why do I think this is so important? And why is this form the foundation of our investment strategy? So first of all, a quick special thanks to my team for being awesome. I had a lot of people chime in and give feedback on this presentation. To our clients for trusting us. That's a really big deal and something we take very seriously. And to my good friend Warren Buffett for the amazing quotes used herein within this presentation. Why turn to anybody other than the GOAT for advice? So on this next slide, I use this picture because investing often feels like this, like climbing a very treacherous, steep mountain. You don't know if you're going to survive sometimes. There are ups and downs, but usually if you keep going, you'll experience mostly ups. Our consistent investment advice has been to invest in real companies by owning, which implies stocks, low cost, low turnover, highly diversified mutual funds for the long term. Buy and hold, possibly forever. The purpose of this presentation is to teach some of the fundamental guiding and qualitative, that's very important, principles as to why we advise this plan. You will also learn why these principles and the corresponding advice that we give is not a fad or a trend and will never change. When the market was going down this last year, many of our clients asked us, what are you guys doing differently now that the market's going down? And the core principles never change, regardless of what's happening today in the weather of the market. So real quick, what others are saying about buy and hold. This was from Forbes magazine in 2012. Wake up, buy and hold doesn't work. And from Seeking Alpha blog, why buy and hold doesn't work. And from our good friend, James RevShark Depore, I don't know who would follow advice from somebody with the nickname RevShark, but he says, it's compounding, not buy and hold investing. That's your path to great wealth. But my favorite quote on buy and hold is, again, from Buffett, our favorite holding period is forever. To be clear, this is our advice. Our general high-level advice, and it has never changed. Invest in yourself first. Become a really good doctor, an expert clinician. Number two, invest in your business that you run. Buy or start up a practice and become really good at owning and running your practice. Three, invest in your life, especially your relationships, and especially if you're married, your marriage. Number four, live on less than you earn and keep your lifestyle, dare I say, modest. And principle number five, using a buy and hold strategy, invest your money in low cost, low turnover mutual funds, following the advice of someone you trust. In my personal opinion, if you follow this plan, you will not be able to help but become wealthy. Does this sound too easy? Again, from our good friend Warren Buffett, there seems to be some perverse human characteristic that likes to make easy things difficult. Again, the purpose of this presentation is to focus on some of the qualitative principles as to why we advise buy and hold as part of this plan. It's easy to measure data and look at numbers and learn what happened. Sometimes data can't even explain why it happened, but it's qualitative reasoning that will help us know what will happen as we look to the future. So I'm going to go over today 6 very easy guiding principles. Principle number 1, businesses or companies are the source of all economic output. There is no economic output outside of businesses or companies. Number 2, companies sell shares to raise capital. not so that you can retire. You're retiring as a byproduct, which we'll get into. Principle number 3, to be a true investment, an expected return or production of the underlying asset is required. Principle number 4, the stock market is not an investment. It is, as the name implies, a market or a place to buy and sell ownership of public companies. Principle number 6, the success or profitability of businesses is not merely a hope of investors. It's essential for our survival as a society. And principle number 6, the total return to investors is the income of the company, whether paid out as a dividend or reinvested or retained by the company. If the above are true, the most rational investment strategy is to own the productive capacity of companies, which is to say, buy and hold shares for the long run. Now, I want to take a quick pause for a minute and remind everybody of the question and answer section. I also want to point out the chat function. There are a couple of times when I'm going to ask a question and ask people to chime in via the chat. And during the presentation, I'm hopeful that you'll have questions from the things that I say, anything at all. And at the end, I will stick around as long as possible to answer every question that is asked. So principle number 1, businesses are the source of all economic output. Now, in this slide, I chose the image of a farm in the background on purpose. A farm is the most basic image of investing. You invest a seed or plant a seed, you plant it in soil, you nourish it, water it, and you wait a long time, and you wait, and then finally it will bear fruit. And if you're trying to gain money off of investing in trees, you don't cut them down, you don't trade them away, you wait and you let them bear fruit. But even farming, in order to be truly profitable, requires a business. Here's what I mean by that. Businesses are the source of all economic output. That's my claim. By business or a company, I mean people organized, either one person or many, and engaged in a productive effort to add value by creating goods and services that improve life for others. So here I have 6 people who organized with an idea and a productive effort seeking to add value by creating goods and services. So quick question and quick something to drop into the chat box. The first person who can name all 6 of these people and get them accurate wins a prize, okay? So I'm going to give you about 30 more seconds. Number 1, who's this guy? 2, this guy. 3, 4, 5, and 6. First person to get all 6 names in wins a prize. And let's see, 5 more seconds before I'm going to continue. Ryan, when you get all 6 accurate, you go ahead and tell me who the winner is. And in case you don't know.
Well, I'm just envisioning everyone frantically Googling right now, because that's what I was about to start doing.
Well, Google a picture.
Yeah.
Go ahead.
Yeah. Ryan Rush. You see that, Nate?
Phil Knight, Paul Allen, Bill Gates, Steve Wozniak, Steve Jobs, Jeff Bezos, Ryan Rush. What a baller. Good job. Ryan Rush wins a prize. I will not forget that, Rush. Good job. Okay. One interesting thing is that if it weren't for the stock market and what the stock market brings to these companies, you would have never heard of any of these guys. And we'll talk more about that in a minute. Principle number 2, businesses sell ownership to raise capital. That is the sole reason that any of these guys sold ownership in their businesses to raise capital. So why do businesses sell ownership or sell stocks? What happens is you've got a founder or a group of entrepreneurs who have an idea, but in order to make this idea a reality, they need capital or money. And so here's a picture of Jeff Bezos on June 15th, 1997, the year that, or the day that they took Amazon public. So the founder or the group of entrepreneurs plus capital enables the creation of the companies that we know. Per Forbes.com, I looked this up today, Jeff Bezos currently owns just less than 10% of Amazon. So he sold over 90% of the shares to raise capital necessary to create the Amazon we currently know. The vast majority of Amazon is owned by us. So why do businesses sell ownership? Remember this, businesses sell ownership or shares of stock because they need to raise capital. Their vision, what they want to create, has raced far ahead of their ability to afford to make it a reality. If you own stocks, you'll make money while you sleep and will eventually retire. But stocks exist and companies sell them to raise capital, not so that you can make money while you sleep and retire. Jeff Bezos did not sell 90% of Amazon because he's a nice guy or because he's a public benefactor. The Amazon we know today would not exist if he didn't sell. Why is that so important? It's important to understand this natural force that brings companies starved of capital and needing capital, and investors who need an investment return, who have capital available. There's a natural force bringing them together. So the performance of your companies and the fact that you own these shares isn't just because somebody wants to create a retirement for you. That's an important fact. It's important to always know, where do the natural laws exist? Principle number 3, to be considered a true investment, there needs to be an expected return, aka production from the underlying asset. So question, what do all these investments have in common? Go ahead and drop an answer in the chat box, and I'm just going to look and see what people say. That's the question. What do all of these investments have in common? And for the sake of time, I'm going to answer my own question. With all of these investments, there is zero expected return. So let me go back and show them to you. You've got several commodities here, very valuable, right? Useful, but zero expected return. This egg is not going to produce another egg. This ball of cotton is not going to produce another ball of cotton. Neither is this bar of gold going to give birth to another bar of gold. Even the land, if not farmed or developed, is totally useless. So there is zero expected return from the investments on the other page. With each of these speculative investments, the bigger fool principle is invoked. Now, I don't want to offend anybody here, but the bigger fool principle is that in order to get a positive return, you need to find a bigger fool than you to sell to. When you buy stocks, aka ownership of business, on the other hand, you literally buy the production of the business. In other words, you put your money to work. So one share of Amazon stock gets you all of this production, literally working for you while you sleep and do nothing, because of the capital that you contributed to the company. And here's a picture of the inside of an Amazon warehouse called a fulfillment center is what they call it. So I want to read this quote to you. It's kind of long, but it's really good, and it emphasizes this principle. This was from Warren Buffett in his 2011 letter to shareholders. Today, the world's gold stock is about 170,000 metric tons. if all of this gold were melded together, it would form a cube of about 68 feet per side. Picture it fitting comfortably within a baseball infield. At $1,750 per ounce, gold's price as I write this, its value would be $9.6 trillion. Call this cube pile A. Now let's create a pile B costing an equal amount. For that, we could buy all the US cropland, 400 million acres with an output of about $200 billion annually, plus 16 ExxonMobils, the world's most profitable company, one earning more than $400 billion annually. After these purchases, we would have about 1 trillion left over for walking around money. No sense in feeling strapped after this buying binge. Buffett goes on to say, can you imagine an investor with $9.6 trillion selecting pile A, the big block of gold, over pile B? A century from now, the 400 million acres of farmland will have produced staggering amounts of corn, wheat, cotton, and other crops, and will continue to produce that valuable bounty, whatever the currency may be. ExxonMobil will probably have delivered trillions of dollars in dividends to its owners and will also hold assets worth many more trillions. And remember, you get 16 Exxons. The 170,000 tons of gold will be unchanged in size and still incapable of producing anything. You can fondle the cube, but it will not respond. Now, Buffett does such a good job of illustrating the importance of an expected return and the importance of the productive nature of an investment. Now, if you wouldn't take $9.6 trillion and choose the big block of gold over the 16 Exxons and the cropland, why would you even choose 1 ounce of gold over shares or $1 of gold over $1 worth of shares of company? If it doesn't work at the macro level, why would it work down at the micro level? This principle emphasizes the essential nature of having an expected return as part of what I would call an investment, as opposed to what I would call just a purely speculative fun asset. Principle number 4, the stock market is not an investment. The underlying company is the investment. What's the takeaway from this? Don't be spooked by the market boogeyman or what other foolish participants in the market do. A market is simply a place to buy and sell. The stock market is no more an investment in and of itself than Amazon is what you're getting for Christmas. Over here, I've got a picture of the Amazon marketplace. With this knowledge in mind, terms like the market is risky and we don't trust the market. We're looking for investments outside of the market. I often hear, I want to invest in something I can go down and touch and feel with my hands. As if the market is just this some nebulous sum of ticker symbols. The true investment is the underlying companies. The market is simply a place to trade. Whenever you think of investments, you should picture in your mind the actual companies with real people and products working hard to add value and to get better. As a side note, we not only recommend investing in companies, but publicly traded companies. Why? Publicly traded companies provide these massive benefits to investors who want to preserve their investments. A proven product and management, oversight by the SEC, at least American companies, audited financial statements provided to the investing public, and registration with a public exchange like the New York Stock Exchange. This is essential so that you know what you're actually getting. Compare this to buying stock in your buddy's startup or selling your practice in exchange for shares of your favorite DSO. With that, you have no idea what you're actually getting. You have no idea how many shares are outstanding, how many shares you're getting, what the class of those shares is, the value of the company, and therefore the value of the shares that you're actually getting. As far as you're concerned, you're getting toilet paper. When we understand that we're not investing in the market, we should no longer refer to our investments as the market or even stocks or shares or funds. What would be far more accurate and descriptive would be to refer to our investments as ownership of the greatest companies in the history of the world, which the publicly traded companies of the world are just that. Principle number 5. Now, remember, before I go on to this next principle, if you have any questions, please drop them into the Q&A section. Principle number 5, the survival of our way of life depends upon the success of our companies. So again, my statement, the success of companies necessary for survival. Consider this biological fact. Every day, everyone on Earth wakes up hungry and eventually goes looking for food. In our modern world, this means we go to our jobs to earn money for food. Then we go shopping for the food we need. If we don't have a job, we have no money and we starve. If there are no stores, we can't buy food and we starve. Now, I'm using food here to describe much more than food, but I'm using food to represent everything that we need. So consider these people who are going to work again at our company of the day, Amazon. All of these people are working hard and care very much about the success of the company. The success of Amazon is dependent on them getting a paycheck, which is dependent on them putting food on their tables, very literally. So Amazon's success is not merely to give you, the investor, your entitled investment return. It's essential for the survival of these people and, on a macro scale, the survival of our entire civilization. So will a company survive? Consider this equation, which is simply the equation for the profit and loss statement, also known as the income statement, which is the income of a company, or the profit, is equal to the revenue earned minus the expenses paid by that company. So as I've said before, in order to survive, companies need to figure out how to be profitable. Well, in order to have an income or a profit, they need to generate a revenue. The revenue for companies is not only important to the company, but it's also very important to us. I want you to think for a minute of a time when you wanted to buy something, but were unable to do so because that thing was unavailable. So again, ponder that question. Have you ever wanted to buy something but couldn't because it was unavailable? The revenue that companies generate is not just for the shareholders or the managers or the employees of the company. We, the consumers or the individuals who live, need those companies and the products they provide. I remember in 2020, I was trying for almost a year to buy dumbbells, weights, and I couldn't do it. Finally, I was able to buy some, but I couldn't for a very long time. And remember this about expenses that a company incurs. Every expense, whether business or personal, is someone else's revenue. So think of your own business and all of the expenses that you incur. Every single dollar of expense that you incur is revenue to somebody else. So this is kind of a pixelated slide. My good friend, Sean Wilson, one of my coworkers, sent this to me, and I think it's a great image or graph or whatever you want to call it, and it describes the symbiotic relationship between businesses and households or individuals. So I'm just going to take a minute and describe it. So over here we have businesses. You guys know what those are. And over here we have households or individuals, which is all of us. Up here, we have this place where businesses, here and down here, there are these two places where businesses and individuals or households come together. The first place is called product markets, a place where we buy and sell goods and services. And down here, what we call resource markets, primarily think of labor markets. So businesses provide goods and services to product markets that are then purchased. These goods and services are purchased by households. Those are the things that they need to survive. The households provide money, bring money into product markets, which becomes income to the businesses. And likewise, the households provide labor to resource markets or to the labor markets, and that labor resource is what fuels businesses. And the businesses then pays money or an expense or cost to the business back, which becomes income for households, which allows them to consume, which is income for the business, and so on and so forth. The households then save some of their money, which becomes investment income or investment for the businesses, which, going back to my earlier slide, allows them to take their vision and make it a reality. This is a very important slide for any investor to understand. Very simple, something you guys already do understand. I just don't know if you put it all together this way. But what it shows, and it's not my opinion, this is a natural phenomenon. It's a scientific fact that this exists. This symbiotic relationship between businesses and households. If households suffer, businesses will eventually suffer. If businesses suffer, indirectly and eventually households will suffer. And likewise, if households thrive, businesses will thrive, and so on and so forth. So, very important to understand this concept and to understand that the businesses we're investing in, and this is the big point, it's not merely an investment return that we're hoping for you or for me. It's just a fact of nature that this will occur, that the businesses will generate an income. Now, sometimes businesses don't survive, but most of the time when a business does not survive, it is because a better business came along, thus improving the economy for the majority. So this question, Nate, are you guaranteeing that companies will be profitable? Absolutely not. But I am saying that if they're not profitable, they will die. And if they all die, so will most of us. If all the companies go under, I would ask this question: what could you have done with your money to preserve your standard of living? This is a really important thing to ponder and to consider. We often have clients ask the question, well, what happens if it all goes to zero? What happens if all of my investments just crash? Well, if that were to actually happen, then I would ask this question in reverse. What could you have done to preserve your standard of living? Everything goes to rubble. How are you going to still live like a king? And the answer is you're not, because of this symbiotic relationship between the businesses and the individuals and the investors. Principle number 6, moving on. This is really important. The income of a company is the total return to an investor. So what can a company do with income? So here's, again, a quick income statement, also known as a profit and loss statement. The revenue minus the expenses gives you your income. What I'm saying is it's this income that is the total return for investors. So here's what a company can do with its income. Thing one, they can pay the income to the owners as a dividend, literally a cash payment, a check sent to the owners. Now, if you don't think that you're getting this, log into any of your Charles Schwab accounts and look at the transactions, and you will see the multitude of dividends flowing in about once a quarter into those accounts. But the second thing that companies can do, and this is very important for you to understand, and understand that this happens and is happening every day, is that companies can reinvest the income. And the accounting term is retained earnings. They're retaining the earnings for reinvestment. Very important to understand. Here's another kind of pixelated slide. This was from the 2018 Berkshire Hathaway letter to the shareholders, written by our good friend Warren Buffett. He says this: our investees, meaning the stocks that they own or the companies that they have ownership of, paid us dividends of $3.8 billion last year, a sum that will increase in 2019. Far more important than the dividends, though, are the huge earnings that are annually retained by these companies. Consider as an indicator these figures that cover only our 5 largest holdings. He then lists the 5 largest stock holdings that Berkshire Hathaway owns: American Express, Apple, Bank of America, Coca-Cola, and Wells Fargo. And right here, he lists the dividends by these 5 companies. But then he says, far more important than the dividends, they got almost $3 billion of dividends just from these 5 companies, are the earnings retained by these companies, totaling over $6.8 billion. And that wasn't the retained earnings by the companies as a whole, that was Berkshire's share of the company's retained earnings. So Warren Buffett's pointing out that, okay, dividends, everybody gets dividends. But more important than the dividends are the retained earnings. Why is that? Why is this such an important point? Why did he call this out and say far more important than dividends? And why am I telling you, why am I putting it in the slide and sharing it with you? Let's use Amazon as an example. What has Amazon done with its earnings? First of all, Amazon owns more than 80 private label brands. Have you guys ever bought an Amazon Basic? Like batteries, for example? We buy Amazon Basic batteries all the time. In fact, I probably have some right here in my mouse. That's an Amazon private label brand. Also, Amazon owns over 40 subsidiaries, including Audible, Zappos, Diapers.com, Goodreads, and so forth. These are companies that Amazon has purchased with retained earnings. This shows Amazon's revenue since 2019. Now, I use Amazon as an example because I'm continuing at the example, but also because Amazon has never paid a dividend to its shareholders. In 2009, the revenue from Amazon was $24 billion. In 2022, the revenue ballooned up to $502 billion, most of that government stimulus money. Amazon's EBITDA, a term beloved by every dentist, is since 2009 has grown from 1.5 billion in 2009 to $51.5 billion in 2022. So why, again, does Amazon reinvest its earnings rather than pay them out as a dividend? At some point, maybe after Jeff Bezos dies, the board of directors of Amazon will decide to start paying out its profits in the form of a dividend. At some point that will happen. But until then, the Amazon board of directors has all agreed that they could be far more profitable and get a much better return on their investment by retaining those earnings and reinvesting the earnings themselves than paying them out to the shareholders. So during the same period of time, December 24th, Christmas Eve 2009, Amazon shares were trading at $6.92 a share. 12/31/22, the shares were trading at $84 a share. And the share price peaked on June 9th, 2021 at $185.97 a share. So obviously, so here, what's the point in all of this? Over time, reinvested earnings drives up share prices. Why do stock prices increase and continue to increase? It's because they reinvest the earnings and grow the companies, which drives up the share price. Those who own the shares own the earnings, both the dividends paid and what is retained for reinvestment, again, as reflected in the stock price. If this is true, and it is, then the goal is simple: own the shares. In other words, buy and hold. Quoting Warren Buffett, our favorite holding time period is forever. Of course, why would you do anything else? In conclusion, to wrap up this long lecture, Please remember these principles. Businesses are the source of all economic output. Invest in businesses. Businesses sell shares to raise capital, not so that you can retire. You retiring is a byproduct, or your passive income is a byproduct of the businesses needing to raise capital. Number 3, to be a true investment, an expected return or production is required. 4, the stock market is not an investment. It is, as the name implies, a market, a place to buy and sell ownership of public companies. Number 5, the success or profitability of businesses is not merely a hope of investors, it's essential for our survival. Number 6, the total return to investors is the income of the company, whether paid out as a dividend or reinvested by the company. And if the above is true, and it is, the most rational and proven investment strategy, not just historically, but will be forevermore, is to own the productive capacities of companies, which is to say, to buy and hold shares for the long run. So what should you do? I always tell our clients to do 2 things when it comes to investing. Focus on investing as much as you can, buying more shares. And number 2, pray that the market goes down so that you can buy more shares at a cheaper price. So that brings me to the end of the presentation.